Imagine watching your bank balance grow while the taxman takes less than ever before.
That feeling of relief, that surge of confidence, is exactly what we're going to tap into today, as we explore the hidden world of deductible expenses for freelancers and entrepreneurs on the path to financial independence.
Early retirement.
I'm a former corporate accountant who left the 9-to-5 grind to build a freelance career.
And I've spent years uncovering the tax strategies that let creators keep more of what they earn. In the next 15 minutes, you'll learn how to turn everyday costs into powerful tax shields, freeing up cash that can be invested straight into your FIRE plan.
First, let's get clear on what a deductible really is. In tax language, a deductible is an expense that is both ordinary and necessary for the operation of your business. Ordinary means it's a common cost that other people in your field also incur, and necessary means it directly contributes to generating income. The key distinction is between business and personal expenses. A coffee you buy at a cafe while scrolling through client emails can be a business expense, but the same coffee bought for a family brunch is personal and not deductible. The line can feel blurry, but the IRS looks for a clear connection to your trade or profession. Your legal structure plays a crucial role in what you can claim. If you operate as a sole proprietor, you report business income on a schedule attached to your personal return, and you can deduct expenses directly against that income. Forming a limited liability company or an S corporation creates a separate legal entity, which can make it easier to separate personal and business finances, and can also open up additional deduction opportunities, such as health insurance premiums paid through the company. While setting up an LLC does involve a modest filing fee and ongoing compliance, the clarity it brings to your bookkeeping can be worth the effort,
especially when you're aiming to maximize every tax-saving opportunity.
Now, let's talk about record keeping, the backbone of any successful deduction strategy. The tax authority requires you to keep receipts and documentation for anywhere from 3 to 7 years, depending on the type of expense and whether you're audited. In practice, the safest rule of thumb is to retain everything for at least 7 years. Digital tools have made this process far less painful. Apps like Expensify or QuickBooks let you snap a photo of a receipt, tag it with a category, and store it in the cloud, where it's searchable and backed up. Even a simple system using Google Drive folders, organized by year and month, can keep you compliant. The habit of logging each expense as soon as it occurs prevents the dreaded end-of-year scramble and ensures you never miss a write-off. Why does this matter for your FIRE journey?
Every dollar you save on taxes is a dollar you can funnel directly into high-yield investments, whether that's index funds, dividend-paying stocks, real estate, or even a diversified crypto portfolio. Reducing your taxable income accelerates the compounding effect that is the engine of early retirement. Think of deductions as a lever that amplifies the power of your savings rate, moving the finish line of financial independence closer with each tax-saving move you make. With the foundations set, let's dive into the core categories you can start claiming right now. The first, and perhaps most well-known, is the home office deduction.
If you have a dedicated space in your home that you use exclusively for work, you can deduct a portion of your rent or mortgage, utilities, internet, and even home insurance. The calculation is based on the square footage of your office relative to the total square footage of your home. For example, if your office occupies 10% of your living space, you can claim 10% of those household costs as a business expense. It's essential that the area is used solely for business. A dual-purpose room can jeopardize the deduction. Next, consider equipment and supplies. Laptops, monitors, smartphones, and even ergonomic chairs are all eligible if they are used for your business. The IRS allows you to either expense the full cost in the year of purchase under the Section 85 deduction, or to depreciate the item over several years.
For most freelancers, expensing the full amount in the year of purchase provides an immediate tax benefit, especially if the equipment is essential for delivering services.
Keep the purchase receipts and note the business purpose in your records.
Travel and transportation expenses also offer significant savings.
If you drive to client meetings, co-working spaces, or industry conferences, you can deduct mileage at the standard rate set by the tax authority, which covers fuel, maintenance, and depreciation. Alternatively, You can keep a log of actual expenses like tolls and parking fees. For air travel, lodging, and meals incurred while attending a business conference, the costs are deductible, though meals are generally limited to 50% of the expense. The key is to document the business purpose of each trip, retain boarding passes, hotel invoices, and a brief note on the agenda of the meeting. Health insurance premiums are another often overlooked deduction for self-employed individuals. If you purchase health coverage on your own, you can deduct the full amount of the premiums, reducing your adjusted gross income. This deduction is taken on the front page of your tax return, which means it can lower the amount of income subject to self-employment tax as well.
It's a powerful tool that not only protects your health, but also your financial plan.
Retirement contributions made through a solo 401k or a SEP IRA are also deductible.
By contributing a portion of your net earnings to these retirement accounts, you lower your taxable income while building a nest egg that grows tax-deferred.
The contribution limits are generous for high-earning freelancers, allowing you to set aside a substantial sum each year. Remember to calculate contributions based on your net self-employment income after deducting business expenses, which creates a virtuous cycle of saving and tax reduction. Marketing and advertising costs, whether you spend on social media ads, a website domain, or a professional logo, are fully deductible. Even the fees you pay to platforms like Patreon or Substack for hosting your content count as business expenses.
These deductions not only reduce your tax bill but also encourage you to invest in growth-driving activities without the fear of losing cash to taxes.
Software subscriptions and cloud services are everyday expenses that qualify. From project management tools to design software, each recurring payment can be written off as a business expense. The same applies to internet service, provided it's used for work. If you have a mixed-use plan, you can allocate a reasonable percentage based on the time you spend online for business versus personal use. Education and professional development are also deductible when they directly relate to your trade.
Courses, webinars, books, and even certifications that enhance your skill set can be claimed.
The expense must be ordinary and necessary for maintaining or improving your business capabilities. Keep the enrollment confirmations and receipts, and note how the knowledge gained will be applied to your services. Now that we've covered the main categories, let's pause for a moment. What do you think about your current system for tracking expenses?
Let me know in the comments. I'm curious to hear how you're organizing your receipts and whether any of these ideas spark a new approach for you.
Finally, remember that the power of deductions lies not just in reducing your tax bill,
but in freeing up capital that can be reinvested to accelerate your journey toward financial independence.
By systematically identifying and claiming every eligible expense, you create a feedback loop where lower taxes mean more investment,
which in turn brings you closer to early retirement.
Keep a disciplined record-keeping habit, stay informed about changes in tax law, and treat each deduction as a strategic move in your broader wealth-building game plan.
If this is opening your eyes to new possibilities, subscribe and stay with us as we dive deeper into advanced tactics that can turn every dollar you earn into a stepping stone toward the life you've always wanted.
Let's start with the travel and transportation side of things, because many freelancers think that only big-ticket items are worth tracking, yet mileage and travel expenses can add up to a substantial reduction in taxable income. Whenever you drive your car for a client meeting, a site visit, or to pick up supplies, you can claim a per-mile rate that the tax authority publishes each year. The key is to keep a detailed log that notes the date, purpose, starting point, destination, and total miles driven. A simple spreadsheet or a dedicated mileage app will do the trick, as long as you record the information before you forget. If you use the same vehicle for personal errands, you simply allocate the business miles as a percentage of the total miles for the year. For example, if you drove 10,000 miles in total, and 3,000 of those were for work, you can deduct 30% of your vehicle expenses, which include fuel, maintenance, insurance, and even lease payments. Remember to keep receipts for fuel and service, and note the odometer reading at the start and end of the year to substantiate your claim. Now, let's talk about meals and entertainment, a category that often raises eyebrows, but is perfectly legitimate when handled correctly. The tax code allows you to deduct 50% of the cost of meals that are directly related to your business. This means that if you take a client out for coffee to discuss a project, or you grab a quick lunch while working at a co-working space, you can write off half of that expense. The crucial part is documentation. Keep the receipt, write a brief note on it, indicating who you were with, the business purpose, and the date. For larger gatherings, such as a dinner with a potential partner or a team-building event for a small crew, the same 50% rule applies. But you must be able to demonstrate that the primary purpose was business-related. If the event was primarily social, the deduction would not be allowed. Health insurance premiums are another powerful deduction, especially for self-employed individuals who do not have an employer to cover the cost. The tax code permits you to deduct the full amount of health insurance premiums you pay for yourself, your spouse, and your dependents, as long as you are not eligible for an employer-sponsored plan. This deduction is taken on the front page of your tax return, which means it reduces your adjusted gross income before many other calculations,
effectively lowering the tax bracket you fall into.
Keep the statements from your insurer and a record of each payment, whether it's a monthly direct debit or an annual lump sum. If you also contribute to a health savings account, those contributions are deductible as well,
providing a double benefit of tax savings and a tax-free growth vehicle for medical expenses.
Retirement contributions deserve a special spotlight because they serve a dual purpose. They reduce your current tax bill, and they build the nest egg you need for financial
independence.
As a freelancer, you can contribute to a solo 401k or a simplified employee pension plan,
both of which have generous contribution limits that far exceed those of a traditional employer-sponsored plan.
The contributions you make are tax deductible, meaning they lower your taxable income for the year in which you make them. Moreover, the earnings on those contributions grow tax-deferred until you withdraw them in retirement, at which point you may be in a lower tax bracket. The key is to set up the retirement account early in the year, make regular contributions, and keep the paperwork that shows each deposit.
Many online platforms now offer automated contribution options that pull a percentage of your income each month, making the process painless.
Equipment and technology purchases are often front-loaded expenses that can be depreciated over several years, but there is a shortcut that many freelancers overlook: the Section 152 deduction, commonly known as the bonus depreciation or immediate expensing rule. Under this provision, you can elect to expense the entire cost of qualifying equipment in the year you place it in service, up to a certain threshold that the tax authority updates periodically. This includes computers, cameras, audio gear, and even office furniture, provided it is used primarily for your business. To take advantage of this, you simply need to mark the asset as fully expensed on your tax return and retain the purchase receipt, the invoice, and any warranty documentation. If you prefer to spread the cost over the useful life of the asset, you can use the standard depreciation schedule.
But the immediate expensing option often yields a larger tax benefit in the short term, freeing up cash that can be reinvested.
Marketing and advertising expenses are fully deductible, and they encompass a wide range of activities that many freelancers underestimate. Whether you spend money on a Google Ads campaign, sponsor a podcast, purchase a domain name, or print business cards, each of these costs can be written off as a business expense. The rule of thumb is that if the expense is intended to attract new clients or retain existing ones, it qualifies. Keep the invoices, screenshots of online ad spend, and any contracts with marketing agencies. For social media promotion, you can also deduct the cost of graphic design tools, stock photo subscriptions, and even the time you spend creating content, provided you can substantiate the time with a log and assign a reasonable hourly rate. Phone and communication costs are another area where a simple allocation can yield a meaningful deduction. If you have a dedicated business line, you can deduct the full monthly bill. If you use a personal phone for both personal and business calls, you need to determine the percentage of usage that is business-related. Many freelancers find that a 30% split is realistic, based on the number of work calls, video conferences, and client messages they handle each month. To support this, keep the phone statements and highlight the business calls, or use a call tracking app that separates personal from professional usage. The same principle applies to internet service. If you work from home, you can allocate a portion of your monthly internet bill to your business, typically based on the square footage of your home office relative to the total home size, or on the time you spend online for work versus leisure. Co-working spaces have surged in popularity, and the cost of a membership is fully deductible as a rent expense, just like a traditional office lease.
The advantage of a co-working environment is that you get a professional address, high-speed internet, meeting rooms, and a community of like-minded entrepreneurs,
all of which can be justified as ordinary and necessary business expenses. Keep the membership agreement and monthly invoices, and note any additional services you use, such as printing or event tickets, as separate line items on your expense report. Professional services, such as legal counsel, accounting fees, and consulting, are also deductible. Even if you only need a one-time contract review or a quick tax filing assistance, the cost of that service reduces your taxable income. It's wise to retain the engagement letters, invoices, and any correspondence that outlines the scope of work, as this documentation will satisfy the audit requirements. Now that we've covered a broad spectrum of deductible categories, let's shift our focus to the strategic side of tax planning. One of the most effective ways to keep your tax bill low is to make estimated tax payments throughout the year rather than waiting until the filing deadline. By spreading the payments across 4 quarterly installments, you avoid underpayment penalties and you can better manage cash flow. To calculate the quarterly amount, take your projected annual income, subtract the deductions you expect to claim, apply the appropriate tax rate, and divide by 4. Many freelancers set up an automatic transfer to a separate savings account dedicated to tax payments, ensuring the money is there when the due date arrives. Another advanced tactic is to time your expenses strategically. Since the tax code operates on a calendar year basis, you can accelerate certain purchases into the current year if you anticipate a higher income, thereby lowering your taxable base for that year. Conversely, if you expect a lower income next year, you might defer non-essential expenses to the following year to avoid reducing a smaller tax liability. This bunching approach can be especially useful for large equipment purchases, professional development courses, or even charitable contributions, which are deductible when made within the tax year. Charitable giving, while often overlooked by freelancers, can provide a meaningful deduction if you itemize your deductions. Contributions to qualified nonprofit organizations, whether cash, supplies, or even volunteer time expenses, the latter only indirectly through unreimbursed travel costs, can reduce your taxable income. Keep the acknowledgement letters from the charities, bank statements showing the transfer, and receipts for any donated goods. If you are close to the threshold where itemizing becomes more beneficial than taking the standard deduction,
a well-planned charitable contribution can tip the scales in your favor.
Let's not forget about the home office deduction, which we touched on earlier but deserves a deeper dive because it can be a game changer for remote workers. The simplified method allows you to claim a flat rate per square foot of your dedicated workspace, up to a maximum limit set by the tax authority. The regular method, on the other hand, requires you to calculate the actual expenses associated with the portion of your home used for business, including mortgage interest, rent, utilities, insurance, and repairs. To use the regular method, you must determine the percentage of your home's total square footage that is devoted exclusively to work. For instance, if your apartment is 800 square feet and your office occupies 160 square feet, you would allocate 20% of the eligible home expenses to your business. Detailed records of utility bills, mortgage statements, and repair invoices are essential to substantiate the claim. A final advanced strategy involves the use of accountable plans for reimbursing yourself for out-of-pocket business expenses. Under an accountable plan, you submit expense reports with receipts to your own business entity, which then reimburses you. The reimbursement is not considered taxable income, and the business can deduct the expense. This approach is particularly useful for freelancers who have set up an LLC or corporation, as it creates a clear separation between personal and business finances and can reduce self-employment tax exposure. To implement this, establish a written policy that outlines the types of expenses eligible for reimbursement, the documentation required, and the timeline for submission. Keep copies of all expense reports and supporting documents in a dedicated folder.